can see the sun, I'm rising up, I feel the love now. Oh, it's in my vision. You know I ran around and I got lost, but now I found you. Well, I can't shake this feeling. Oh, it's gonna take me a little while just to get my head around this moment. But I can see the sun, I'm rising up, I feel the love now. Oh, it's in my vision. And it's telling me run, 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 run. Run, 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 and don't give up. And it's telling me run, 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 run. Run, 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 and don't give up.
Welcome to the Retirement Learning Lab, where we teach you how to retire without running out of money. My name is Van Richards, and this is the daily NASDAQ Stock Update. We have two fabulous stocks to talk to you about today, and let me explain the way that our show works. Basically, every day what we do is we pull apart a couple of stocks that are in the NASDAQ 100. Yeah, there are a lot of other things that are going on in the stock market. Every index today was up over 1%. That's great. We heard about Oracle that's going to basically be taking over TikTok. That's great too. But, you know, as you look at all these things that are happening in the stock market, if you have a knee-jerk reaction, if you go, oh, wow, I should go buy Oracle, I should buy this stock because it's going up, you're going to be chasing your tail. And that's not the strategy that we try to help you to develop. What I try to help you to develop is a strategy of accumulating wealth through stocks. And the way to do that is to understand the stocks that you're investing in and then utilize that knowledge to find the stocks that you want, essentially. Now, the stocks that I'm going to talk to you about today, some of them might be overpriced, some of them might be underpriced. But one of the strategies that you can use is, today's not the day to buy this particular stock, whichever one it is I'm going to talk to you about. Put it down someplace where it's like, okay, I like that company. And I'm going to talk about a couple of companies today that you might go, that's an awesome company. I love what they do. And if you like that kind of strategy, when the market pulls back some, you can go, hey, I'm going to go out and I'm going to buy that particular stock. Buy on the dips. That's going to be your best strategy from that standpoint. And buy over the long term. If you're here to try to be a trader, I'm sorry, I can't help you. You might have to tune somebody else. If you want to be the type of person that accumulates wealth, that accumulates money so that you don't run out of it when you're retired, then you're in the right place today. Okay, so let's get started and talk about the two companies that we're going to address today. The two companies that we're going to talk about today are Intuitive Surgical and JD.com. Okay. Intuitive, I'm just going to tell you, this is one of the most amazing robotic surgical companies that's around. When you talk about innovation, this company should be right there in the definition section of the dictionary under innovation. JD.com is kind of interesting because JD.com has more commerce than Amazon. How can they do that? You may not have ever heard of JD.com. That's because you probably are not in China. Yeah, you could listen to this show if you were in China, but if you are, hey, nice to see you. Let me know where you're listening from. JD.com is the largest online retailer in China. And we're going to talk about that stock just a little bit. We'll start with that one. All right, let's move on. Let me make the screen just a little bit bigger for you so that you can see how things are going to go. Now, I'm going to remind you all that as we go through all this information, we want to do three things. Hold on just one second, because I think this is so important to talk to you about. We're going to address three different issues with each stock. And this is the legs of the stool, the three-legged stool that holds up the idea of a good stock. Number one is going to be earnings. If you don't have earnings, then you have a problem. And you'll see that there's some questionable earnings in JD.com and how they're being addressed as we go through this. The second thing that we're going to look at is we're going to look at stability in the market. How competitive are they? And then number three, we want to see the companies that we're talking about. How do they stand up against their competitors? If they have a good product and everything else works out great, but they're not competing very well, then there's a problem in there too. So those are the three ideas that we want to look at today. We're going to look at earnings, stability, and competitiveness. Okay, so let's get back over to what we were talking about today with JD.com. All right. JD.com has really, when you go, if you were to go to their website, you would see a couple of things. And I'm going to pick those off for you. I wrote them down. Now, I don't want to mess them up, so I'm going to read them off for you. Number one is this company is a $119 billion online retail company. They have $82.9 billion in revenue online annually. They have 750 warehouses, 417 million active users, and 90%. This is amazing. And this really shows you a trend of online commerce, not just in China, but in the United States too. They have over 90% of their businesses done on mobile devices. That's awesome. Okay, let's look and see what this stock has done over a period of year, because it's just amazing. It's tearing it up. It started a year ago at $30.74 a share. And today, hey, bing, 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 it hit $76.59. It's off a little bit, but still for the last 12 months, that's up 149.15%. That's incredible. We would hope that it would be able to repeat what's going on. Now, we've looked at what it's done historically. What about the earnings? No, this stock doesn't pay a dividend, but let me tell you what, earnings are something that you have to pay attention to in a stock, because if you don't have earnings, you don't have value. The way that we calculate the value of a stock is based on earnings per share. And when we look at a stock, we want to look at what the estimated earnings are going to be. That can't be a big question mark in there. And with JD.com, even though the past year has had good results, up over 149%, look what's happening with their earnings. I want to make this just a little bit bigger for you, if I could, on the screen that's in front of me, because I want you to see what's going on with the earnings. Okay, look at this. Look how big of a drop was right here. You'll notice that the dotted line is going to be estimated earnings per share, and the solid line is actually what happened. So, you know, you're going along here and you see, okay, whoa, what happened right there? I don't know. What happened right here? And what happened right here? And it's just the estimated earnings and actually what's going on are kind of all over the map. Now, that presents a problem to some degree for some shareholders. And if you are a fiduciary, let's say, for example, if you're a university and you're holding a stock, you really can't tell what's going on inside of this company very much, because they do not adhere to generally accepted accounting principles. Now, you may have heard of that before, referred to as GAAP, G-A-A-P. And that's really a big problem with these companies, because China actually, if you think about it in a way, China's stock market's really not that old. It's only been around since 1990, really. Yeah, well, it was around in the 1940s, and then it was closed down because of communism. And then in 1990, the index, the Shanghai index, I think it's the Shanghai index. Forgive me if I'm wrong on that. It may be a different index, but the Chinese index opened up, okay, in 1990. So it's only really 30 years old from that standpoint. But I want to make this a little bit bigger too. What you're seeing on the screen in front of you. Look at some of the earnings surprises that's been around since 2014. Actually, let's go back just a little bit and look at this. Okay, in let's see, right here. If you can see this, this is actually just from 2020, a surprise of 57%, a surprise of 261%. Now, those are positives. Those are positive. That's good. Let's go down here. 2018, a negative surprise of over 1,000%. Again, in 2018, over 150% down surprise, 600% surprise up. Let's go over and look at some other different numbers. If you look at 2016, a negative surprise of 855%. What's all this mean? What it means is that the analysts can't really tell what's going on for some reason. And that causes a big problem. Actually, the federal government has responded to that. Back in May, the Trump administration ordered federal retirement plans basically to divest themselves of Chinese stocks, because not only is there a trade war going on, but we really can't tell to some degree what's going on inside of some of these companies. Steve Mnuchin, the Treasury Secretary, recommended delisting Chinese firms from the United States stock exchanges if they fail to meet audit standards. Now, when I talked just a minute ago about GAAP, that's the generally accepted accounting principles. Every other company out there in the United States, if you're a company that's established in the United States and you file with the Securities and Exchange Commission, you must adhere to GAAP. If you don't adhere to GAAP, then you don't get to list your stock. How is it that a company that has a different circle of accounting principles can be listed along with and compete with companies that are adhering to GAAP? That's a big disadvantage to some degree. So you have to also ask yourself the question, is the value that you're seeing on some of these Chinese stocks, are they real? Are they real? Do they exist? Or is it on paper? Are they telling the truth? Actually, on August the 21st, just recently, this is Keith Crash. He's actually a State Department representative, and he was urging universities that have index funds to divest themselves of Chinese stocks. Now, why in the world would he do that? Let me tell you why he would do that. If you are a fiduciary, that means that you have to act in the best interest of whomever that you are representing. My business, I act as a fiduciary. I have to act in the best interest of my clients. In a university system, that university has to manage its money in the best interest of the university without any type of bias in itself. If that university cannot identify what is going on with its holdings because of the way that they're doing their accounting, then they cannot act in the best interest of the university. They have a breach of fiduciary duty from that standpoint. And I believe that's actually what the State Department is getting at, is they are suggesting that, not suggesting, they are strongly urging universities to drop Chinese stocks, because the Chinese do not operate with the same accounting principles that we do here in the United States. Now, it's not all gloom and doom, okay? The reason I say that is because the Chinese stock market, again, it's only been around for 30 years. They're relatively new compared to the United States. The United States has been doing this since around before the 1940s. You know, of course, we had the big stock market crash in the 20s. And then in the 1940s, we had a lot of regulation, which was created around managing stocks. And we have to adhere that even still today. So the Chinese are catching up with it. So with that said, I think that it's important to also note, this was in the news actually just yesterday. China issued new rules to tighten controls over financial holding firms. Now, financial holding firms can be stock. They can be publicly traded stock, but they're just holding companies in itself. Now, what they're trying to do is they're trying to get a handle on some of these companies that are operating within China. And as a result, they're trying to regulate their commerce better. And I truly feel that the Chinese want to do more business with the United States. And with pressure from the government, our government, the White House, with pressure from the Trump administration, I think that they will move along and eventually they will make better accounting of what's going on inside of these companies. You see, I used to do part of this broadcast. I used to do a report where I would tell what the insiders were doing. We don't do that as much because it takes up a lot of time. But when we did that, we could see what was going on inside of American companies, but we have no idea what's going on inside of Chinese companies because they don't report it. So you have to have generally accepted accounting principles for it to be able to work. All right, so let's keep moving on and see what's going on. Of course, we told you there's no dividend on this stock, so we're going to keep going on past that. Now, how does this company compete with other companies? JD.com, if you look at who their competition is, Alibaba is an online e-commerce company in China too, and you'll see them represented in the red. Biozun also is an e-commerce company, not anywhere close to the size of JD.com, and it's had a harder time from that standpoint of competing. And this is something I think that's amazing. When we talk about online commerce here in the United States, you can't say that without thinking of Amazon. So how does JD.com compare with Amazon? Here it is. It's actually quite a bit less from that standpoint. But okay, we got two questions in here. One is it real? Are there accounting principles making things up? If it is real, then yeah, this is something that you shouldn't be ignoring from that standpoint. Now, if you're an investor and you don't like the idea of having Chinese stocks, one of the best strategies for you to consider using is going to be indexing. Now, the way that indexing works is this. I help clients do direct indexing. And direct indexing, we go and we buy like the NASDAQ 100. We buy the top 100 companies in the NASDAQ. Okay, those are listed on that electronic exchange, the NASDAQ. But if a client says to me, I don't want anything to do with Chinese companies, there's companies like Baidu, which is kind of like the Google of China. And then there is JD.com, which is the Amazon of China. And personally, I feel like that they're very viable companies, but there could be some question marks as to how they are valued. And if you look at that and go, I don't want anything to do with those companies, then we pull those out and you just own the American companies. But if it's something that you don't really have that much of a concern about, we leave it in, and that's exactly whether we leave it. You can have a direct index involvement with all 100 stocks of the NASDAQ 100 without having it go through an exchange traded fund or through a mutual fund. Okay, let's move on so that we can get into talking about this just a little bit more. All right, and as I talk about all the time, the past performance of these stocks is not a guarantee of future results. So just remember that, okay? I'm not making a direct recommendation to you based on whatever happened in the past. You have to make that decision for yourself from that standpoint. Now, we talk about a moat a lot of times when we talk about the profitability of these companies. I'm going to explain to you very quickly what a moat is. The moat of a company is the barrier that they dig in between themselves and their competition. And really, when we're talking about the moat for JD.com, it doesn't exist. They don't have one. There's no cost advantage for anybody in China to do business with JD.com over top of Alibaba or Biozun. It's just that JD.com has a system in place and they can't offer it any cheaper than their competition, but they do have superior fulfillment capacity. So from that standpoint, they don't have a moat. When we look at the valuation, remember when I was talking about this in the very beginning, what analysts do is they look at the earnings per share and they calculate the fair market value based on the earnings per share. Now, the market value is different. The market value closed today at 76.59. Now, what Morningstar does is they do this calculation, and generally it's about 15 times earnings per share. And what they're saying is that it's close to the current market value. Its fair value right now is at 62, and that's a 19.65% premium. That means it's trading over top of what its fair market value is, and they give it 2 stars. Now, the interesting thing is too, what do other analysts say about this stock? And there's 11 other analysts that were polled, and when they were polled, they came up with the idea that the general thing is that 8 of them said to buy, 3 of them said to hold. So the average on this stock was what? The average is a strong buy for this particular stock. Now, I want to remind you, this is not my buy-sell recommendation. I'm reporting to you what other analysts are saying is out there. My strategy for you, my recommendation for you is to put together a strategy of accumulating money towards retirement, and stocks is one of the way to do it. That's why we take time every day to learn about these. Okay, the next company that we're going to look at today is Intuitive Surgical. Intuitive Surgical is in my opinion, one of the most amazing companies that I've ever seen. And the picture that you see here, let me describe this to you, because once you leave today listening to this, go on to YouTube and look this up. You can see it's a minute-long video. I didn't bring it up today. I'll just tell you about what it is. They have a system that's called the Da Vinci system. It's a robotic surgical system. And what this robotic system does is it sews the skin back onto a grape. It's amazing. And what you're seeing here is you're seeing the hands and the sutures and the grape itself. Today, this stock ended up 1.96%. I love this stock. This is one of these stocks that I'm not going to say that you should go out and buy it today, but I'm telling you what, that if you're making a list of stocks that you should buy when the market drops, I would put this one on that list. This is an amazing company just because of what it does. And that when we talk about moats, this company doesn't, they have a monopoly because they created the system. They're innovating. They have other systems that they're creating. We're going to talk about in just a minute. A year ago, it's a pricey stock. It's $518.78. But hey, remember this, that if you do business through me, I use a custodian called Folio, and you don't have to buy whole shares. You can actually invest. And when we buy the NASDAQ 100, we buy into Intuitive Surgical, but we might not buy full shares. We buy partial shares, and that's one of the benefits of using Folio as a custodian. Okay, so a year ago it started out at 518. Today it ended up at 716.34. So the past year it was up 38.08%. Great year. I got to remind you, the past performance is not a guarantee of future results. There's no dividends on this. This is primarily a growth stock, so we're not going to ponder on that. When we look at the earnings, again, we go back to the idea of earnings as I'll make it bigger for you just for a quick second, because there's not a lot. There's nothing bad to tell about this company. It's all good. Actually, if you look back here, this goes back to 2015. And the dotted line is the projected earnings, and there's not, like right around 2018, they missed the projected earnings just a little bit, but not very far. In the third quarter of 2019, they bumped over top of the earnings. So, I mean, this company is really just, it's awesome. It's done very, very well from the standpoint of growth. Earnings are great from that standpoint. When we look at how it competes with other companies that are out there, there's a couple of other companies that do robotics. Johnson & Johnson is another one. I think that Johnson & Johnson is more into the orthopedic aspects of robotic surgery, but that doesn't mean that they can't compete with Intuitive Surgical. But right now, they're not really in that realm. Nuvasive and also Boston Scientific are competitors as well. But if you follow along the dancing cursor, you see what happened here in between February and March when the market fell. Everybody knows that what happened in there. things kind of stagnated after that point in time, and it's basically because surgeries were put on hold, especially elective surgeries, which a lot of the robotics are used for. But then it picked back up, and we had a spike, and it's just kept on going on past that standpoint. So they compete very, very well. I want to remind you again, the past performance of these investments is not a guarantee of their future results. When we talk about the moat status, this company basically has a monopoly on its niche. Yeah, it could go backwards if surgeons decide to start doing manual surgeries again, and if there's some pressure on hospitals not to buy these really expensive Da Vinci systems, then it's possible that they could go back. But one of the things is with these surgeons, they can increase the number of surgeries that they're doing, and it just makes them more efficient. So I don't think that's really going to be quite as much of a problem. There is competitive pressure. We talk about the other companies like Johnson & Johnson. There are shrinking margins. That means that companies like Johnson & Johnson and NuVasive and Boston Scientific, as they develop competition for like the Da Vinci system, it's going to put price pressure on Intuitive Surgical. So that's a possibility, and it's not really a big problem right at this point in time. The current value, we talked about that a little bit, $716.34. The fair market value on this, according to Morningstar, and it's based on earnings per share, the stock is quite a bit overvalued, according to Morningstar. Remember, this is one of these stocks that I would probably say, okay, I'm going to buy this stock if the market goes down, because I like basically what it does. It's selling right now, according to Morningstar, about 61% over what it's actually valued. So they're only giving it a 1 star. So this is one of those times when you could see that the star system really is not a favoritism system. It's not saying, hey, this is a good company or this is a bad company. It's all based on values. And you have to make your own decisions on this too. So let's look at actually what the other analysts are saying. Out of 16 analysts that were polled on this, we saw that 6 of them were saying that it's a strong buy. 1 of them said it's a moderate buy. And 6 of them said hold. And actually, 3 analysts said that this is going to be a strong sell. But I think when we put it all in all, this stock in itself is still a moderate buy. So as we go along and move on into this, I want to tell you one thing about this. This is the last thing that I'm gonna move into here, because I want to tell you just a little bit about my understanding of what's going on at Intuitive Surgical. Their system it's amazing. Go over and look on YouTube. You'll just be amazed when it shows that skin back on the grape. But they also have another system that they've developed that's called Ion. And Ion, basically what it does is it helps surgeons to identify lung cancer earlier. And the way that it does it orally. They have a robotic device that actually goes in through the mouth and goes into the lungs, and it's guided by the robot into the lungs, and they can actually diagnose a lung cancer earlier with less trauma to the patient. And that's something that's really big right now. A big market actually for this particular device is going to be China, because China does have a lot of lung cancer. Not really sure why, but it's one of those areas that it's developing quite a bit. So the Da Vinci system, although there's pressure from competition like Johnson & Johnson and NuVasive and Boston Scientific, we still look at companies like Intuitive Surgical and see that they are innovating with new developments. And that's just one. There's more from that standpoint. So with that said, I want to say thank you very much for listening today. I'll bring the other screen up real quick, just a second. If you want to talk to me about your retirement plan and about how some of the strategies that we use at my financial planning practice can help you, go to my website at richardsfinancialplanning.com, and down the page you'll see schedule a call to learn more. And this will bring up a calendar so that you can find a time that I can talk to you over the phone and we can talk about your situation and you can ask questions. It doesn't cost a penny. I'll spend 15 or 20 minutes and visit with you. And then if there's a basis to do business further or you have other questions, we can go from there. If you got your questions answered, then you got your questions answered from somebody that's a pro. Hey, all right. With all that, I want to say thank you very much for listening to us today. And I will talk to you tomorrow.